So rising interest rates and inflation are likely to slow down the M&A landscape, and I think we've really started to see that over the last 4 months. Credit's tightening and spreads are widening. We're up probably about 300 basis points over the last 4 months, and I would expect that to continue into the future. So we think about being investors and underwriting businesses. We're really going to have to understand, what impact does that have in the opportunity, and really diving into the revenue and expenses. On the expenses side, as we look at payroll as an example, those costs are going to go up as cost of living goes up, and you need to pay your workers more. And how much of that can really flow through to the customer versus what's going to have to be borne by the business, and ultimately how will that affect margins into the future. With revenue and or growth, we really have to break out what's true organic growth of the business versus what's inflationary growth of the business. At the end of the day, all this is going to get taken out on the seller, right? As investors, we have our higher cost of capital. We have maybe a more gloomy outlook as to the future of the business. And, inherently that's going to bring down the valuation and what's the business worth to us today. For sellers that are a bit less motivated, they may decide it's not the right time to sell and they'll take their business off the market. And for sellers that are a bit more motivated, they'll have to, bring down their expectations in terms of valuation to bring it in line with the market today. At Cloud Equity Group, we're not market timers. And so, we look to remain consistent for our LPs investing throughout the cycle. And so, we're excited about the opportunity and look to continue to invest